This is a lecture from Open Tuition. For the free lecture notes that go with this podcast, please visit opentuition.com.
Well, we ran out of time on our last session together to be able to deal with this next topic area, that is jointly owned assets of a married couple, or indeed by a couple in a civil partnership. Now, the first line here should come as no surprise so far as what we've already learnt about the preparation of income tax computations, because we've already said that every individual, male, female, adult or child, married or single, whatever their personal circumstances, every one of us from the day that we're born exists independently in taxation, and therefore if we have income, we would have our own income tax computation. So of little surprise, therefore, that if you're dealing with spouses or civil partners, that they will be taxed as two separate people, each spouse, each civil partner, with their own individual income tax computation, including upon it, of course, their own figure of taxable income. But then we have a specific issue that arises here. What about if there is a jointly owned asset that generates income? If it's a jointly owned asset generating income, then that income needs to be split between two tax computations, one for each spouse, one for each civil partner there. So when spouses or civil partners own such income generating assets jointly, then it is assumed that they're entitled to equal shares of the income. And it goes by a very simple name and rule. It's the 50-50 basis rule. The 50-50 rule here is deemed to apply. It's just split equally between them. So irrespective of any actual ownership in terms of the capital content of that asset, irrespective of that, we just split it 50-50. Now then, there is, and at the heart of what we do in this section, there is an election that is available to the taxpayers. A joint election here to be made to HMRC to split the income according to actual ownership shares. Now, again, where you'd most likely to see that is something like a jointly owned investment, i.e. rental property, where at the moment the property owned by the two spouses, owned by the two civil partners, is being rented out and generates a net amount of rental income. Then without this election being made, that rental income would be split, again quite reasonably, quite sensibly we might say, 50-50 between the taxpayers. Now this election is available in relation to jointly owned assets other than in the case of bank or building society accounts there, where the interest income generated by that will be split 50-50. There is no such election in relation to that type of interest income. But otherwise, and again, the most likely one that we'd ever see would be property income on a jointly owned property. Now, what this allows the couples to do is to rearrange that joint income between them in order to better use their personal allowances, and if at the moment both spouses, both civil partners are using their personal allowances, then it may be that they're able to reduce the tax rate that is charged and therefore reduce the overall tax liability. For example, by moving income from a higher rate to a basic rate spouse. That would move income from being taxed at 40% to being taxed at 20%, or moving income from a basic rate tax-paying spouse to a non-tax-paying spouse, therefore removing income at the moment that's being taxed at 20% and putting it into the spouse or civil partner's income tax computation, where it won't be taxed at all because it's covered by the available personal allowance that would otherwise have been mostly wasted there. So this gives us the opportunity to be able to display some tax planning skills as to how to improve the current position for our taxpayer couple or civil partnership here, to be able to improve their tax position, to be able to reduce their overall tax liabilities. Now be careful what this election allows the taxpayers to do. It does not allow them to split this income any which way they want. This election does one thing. It stops it from being a 50-50 split and makes it a split according to actual ownership. Now, of course, in any exam question, you must be told what that actual ownership is. Now, that's going to be, of course, something other than joint 50-50 ownership. It may be 60-40, 75-25, 80-20, or whatever it wants to be there. But that election moves it from 50-50 to the actual ownership, not to some made-up figure that they might prefer. No, according to actual ownership there. Now then, what we'll do is to have a little look at a little made-up example that will illustrate the beneficial use of this election and the circumstances in which it would be advisable, and how then we can establish easily the tax saving that may be achieved from such an election being made. Where this particular subject and this style of question could come up could potentially be in section C in our constructed response written answers to the 10-mark question. The 10-mark question, which we said in our original introduction, might be the more interesting question on the paper, whereby we're asked to apply our skills to maybe use some tax planning, basic tax planning techniques to improve the tax position of the taxpayer, or here the taxpayers, the married couple or the civil partners there within this civil partnership. Now, that 10-mark exercise, we're thinking that's a lot of marks solely to be testing out one particular issue. Now, it wouldn't just be testing out this one issue. There's a variety of issues and, of course, all your basics of calculating income tax so far as any individual is concerned. But the scenario I'd suggest to you is one that could be used for such a 10-mark question. All right, for that purpose, we're going to look at a little made-up example now, which I will attempt to find and get on this screen. Okay, so in our example, we've got Brad and Angelina are a married couple, or possibly were a married couple by now. Angelina has income in 2015-16 of £40,000, including property income of £5,000, and that £5,000 is from a property jointly owned with Brad. Brad's only income is £5,000 from that property. No elections have been made by the couple, but we're then informed that the actual ownership of the property is 80% Brad and 20% Angelina. Okay, so without any elections occurring, what would be their income tax positions for our 15-16 tax year? Clearly, Angelina has £40,000 of income, and poor old Brad has only got his £5,000 worth of property income there. That's going to mean that once we've deducted our personal allowance, that Brad will be paying no income tax at all, and of course Angelina will be a basic rate taxpayer. Let's just have a look at what that outcome should be. There's the two sources of income in total for Brad and Angelina. Brad with his poor little level of £5,000 there, and Angelina £40,000. Take away the personal allowances. Clearly, as we can see, and an issue that will now come through on this, is that Brad is wasting a significant part of his personal allowance. Maybe there's an election that can be made there to again salvage at least some of that otherwise wasted personal allowance. What else have we got? We have got, of course, Angelina, after deducting the personal allowance, has a taxable income of £29,400, making her therefore just a basic rate taxpayer. So Brad's paying no tax, Angelina is a basic rate taxpayer, and Brad is wasting a considerable part of his personal allowance. Now, notwithstanding the point about our jointly owned income here, jointly owned property generating that joint income, we have an issue about the wastage of the personal allowance. Now, I'm hoping that you will be remembering an election that would be available here to at least gain some benefit, of course. Not all, but some benefit out of the otherwise unused personal allowance. So can you have a little think about what that might be now, and what the effect would be of that election? Let's think about transferability of any part of that personal allowance, and then redo what our calculation of the tax liability of Angelina would be. Brad's won't change, it will still be nil. But is there a way by which that tax charge on Angelina of 5,880 would be able to be reduced? Have to think about that, would you, for a moment, please? Okay, so what could we do, therefore, to improve the tax position of the married couple? Well, as Brad is wasting a significant part of his personal allowance, at least some of that will be able to be transferred. I hope you remember that election for the transferability of the personal allowance and how much of that personal allowance could be transferred. The rule was that we could transfer by election 10% of that personal allowance. So that would therefore take away £1,060 of the personal allowance of Brad. So let's just put our revised figure in there. Taking away 1,060, 10% would be what? £9,540. Now that, of course, does not change Brad's position. He's still got no taxable income, therefore no tax liability. Remember the effect of the transference across to the spouse Angelina. It doesn't increase her personal allowance by £1,060, but it gives rise to a personal allowance tax reduction, a tax credit, so far as her tax calculation is concerned. And that personal allowance tax reduction that will be permitted here, otherwise known as the marriage allowance, of course, is that 1,060 times 20%. And that, of course, is a tax credit of £212. That obviously will reduce, therefore, the 580 by the 212. Also, of course, the situation must be viewed as, is this one where the election would be available? It's clearly worthwhile, but would it be available? Yes, it would, because Angelina, with her taxable income of £29,400, is indeed just a basic rate taxpayer. That transference only allowed where taxpayers are either non-taxpayers, as per Brad, which is the situation where some of the personal allowance would seek to be transferred, and of course where the other spouse is no more than a basic rate taxpayer. So that's okay in terms of our situation here. So there's one election that certainly would be worthwhile in reducing down, therefore, the overall tax charges of the married couple, specifically in the name of Angelina, by £212. Again, a welcome, therefore, reduction in the tax charge. But possibly we can think about something else as well, given the content of this particular chapter, whereby what we're aware of is our, well, as we call it, a declaration of beneficial interest, an election whereby, rather than applying the 50-50 rule for joint income, which is what would otherwise have happened, as is the case here, the declaration of beneficial interest would instead split that total, obviously a total of £10,000 worth of property income. Instead of 50-50, 5,000, we'd be able to split it according to actual ownership, which, as you see here, is 80% Brad, 20% Angelina. Well, would that election be a good idea here? Yes, it would, because that would move income from Angelina's tax computation, where currently it is being taxed at 20% basic rate, and over into Brad's computation, where it wouldn't be taxed at all. Let's just look at the revised outcome as what would happen. 80%, 20% will of course be an £8,000 split between them. So in which case, therefore, what we'd now have, so far as Brad is concerned, is rather than £5,000, that £5,000 would go up to £8,000, of course, there. That would go to 8,000. Now the personal allowance, still with the transference in place, would be 9,540, so still the tax liability is nil. That hasn't changed. But what will now happen, of course, so far as Angelina is concerned, Brad's taxable income figure, Brad's income figure has gone up by 3,000. So, whoops, a daisy. Angelina's income figure will go down by 3,000. So we've moved £3,000 across from Angelina to Brad. Brad's gone up from 5 to 8, and Angelina goes down therefore to £37,000. She's still got her personal allowance of £10,600. Take that away, and we're now therefore looking at £26,400 worth of taxable income. That £26,400 will therefore go into our calculation here, £26,400 at 20%. That of course will now bring that down. Let's think 2 times 2, 640, 5,280. So we brought that down to £5,280. So £3,000 of income that was previously being taxed at 20%, i.e. £600 worth of tax. That £3,000 of income has moved from Angelina across to Brad. That therefore has not increased his tax because it's just absorbing more of an otherwise wasted personal allowance, so there will be no tax charge. Hence a saving of £600. What was £5,880 has become £5,280. And of course we've still got the benefit of the personal allowance tax reduction to reduce Angelina's tax charge by a further £212. We have therefore been able to take advantage here of 2 elections that were worthwhile. We have been able to still get the transference of the unused personal allowance, giving a £212 tax credit to Angelina, and a rather bigger saving by moving £3,000 of income from what would have been in Angelina's over to Brad's computation. That's another £600 worth of tax saving. So just have a little look there at how those elections have been worthwhile so far as the married couple are concerned. Okay, sticking with our example of Brad and Angelina, I've just gone back to the question here, as you'll see, and I've changed one thing. What we've now got is that Angelina has income of £50,000, still inclusive of the property income of £5,000 from the jointly owned property with Brad. Brad's income is still the other £5,000. But now I put it at £50,000. Now, what I'd like you to do is, without dealing with the election here to go for beneficial interest to split according to the actual ownership 80%, 20%, I'd like for you, prior to any such election being made, we'll illustrate that separately, to work out what the respective tax liabilities would be in this particular circumstance. So this time, therefore, £50,000 worth of income, including the £5,000 property income from the jointly owned asset. That's what Angelina has. Think what effect that has on the level of taxpayer that she is, while Brad remains at just £5,000 of income and therefore is wasting more than half of his personal allowance. So in that situation now, what would be their respective tax liabilities, making any elections that you think are available other than the declaration of beneficial interest. So leave the income figures as they stand and we'll separately deal with that. So could you therefore have a little go at that now and work out what tax liabilities you think will be applicable so far as each of Brad and Angelina are concerned. Okay, well, if you've had a little go at that for yourself there's our 2 income figures as stated, £5,000 and £50,000 respectively, before this joint election in relation to jointly owned assets is made. The personal allowances, £10,600, £10,600. Our taxable income nil, £39,400, therefore to Angelina. No tax liability on Brad, and then the tax calculation for Angelina, 31,785 in the basic rate band, and then the balance of that, I think 7,615 at higher rate. Now, of course, that brings a tax charge up to £9,403 at this particular point in time. But now, of course, there's the question of that marriage allowance, that transferability of the unused personal allowance. Will there still be a tax credit available here to Angelina? Can Brad transfer the 10% of the personal allowance across to her? This time, of course, sadly, the answer is no. So that tax liability stays as it is. The reason, of course, being, on this occasion, poor Angelina, is a higher rate taxpayer. and on that basis, therefore, the election is not available. Now, although that election is not available, a rather more important election, as we're discussing in this part of the chapter now, is available, and that again is to split that income according to actual ownership. Now, we know what the impact will be. It will therefore reduce Angelina's income by £3,000, and it will increase Brad's income by £3,000. Now, I'd like you to think about, without necessarily doing any detailed calculations here, but what tax saving would be achieved now as a result of that transference. So rather than redoing the tax liability calculations, can you simply go directly to what you think will be the tax saving that will be achieved, moving £3,000 of Angelina's £50,000 income across there and adding it to Brad's. Brad will go up to £8,000, as in the previous example, and Angelina will come down by £3,000 to £47,000. That therefore will reduce that taxable income by £3,000 down to £36,400. So what do you think would be the tax saving? Could you go directly to that rather than working the detailed tax calculations there? Now, of course, what you've hopefully realised here is that by moving £3,000 of income from Angelina across to Brad, in Brad's hands there is no tax at all on that £3,000 of extra income. Whether he's got £5,000 or £8,000, it's more than covered by his available personal allowance, which here will still be the full £10,600. No part of that will be transferable across to Angelina here. Her income will drop by £3,000, so she remains a higher rate taxpayer, albeit that that amount of tax liability here, previously computed at 40%, is going to go down by £3,000. Therefore, the tax saving achieved now, instead of being £3,000 at 20%, as we had before, £600, it's now going to be £3,000 at 40%. So that particular election is going to save the married couple there £3,000 at 40%, some £1,200. So even more beneficial when we are moving income from a higher rate taxpayer, not just to a basic rate taxpayer, where of course it would have saved tax at the difference between 40% and 20%, i.e. 20% saving, but if, as with Angelina and Brad, you can move it from a higher rate taxpayer to someone like Brad who is a non-taxpayer given their level of income, then you're saving tax at 40% compared to 0%, 40% saving. That's about as good as it's going to get, and we can see here the benefit of that election being made. Clearly, it's only a good idea where you're moving income away from the higher level taxpayer to the lower level taxpayer, such as you see in this particular situation. Okay, in which case, if we're happy with what we've seen there, the benefit of the election, also combined it, of course, with, again, a little bit of revision about the transferability of the personal allowance and the tax credit that attaches to that to the transferee spouse. But if we're all okay with that, hopefully we are, let's therefore now return back to the chapter in our OT course notes and move ahead with that section 6, jointly owned assets of a married couple there.